Good day, everybody. This is Jim Kinney for the weekly market update for Option Professor. And this, of course, would be October the 12th, 2018. As we always say, remember, past performance is not necessarily indicative of future results. And when you're doing short-term trading or option trading, it does involve substantial risk and is not right for everybody. So do consult with your advisors and your clearing firm and yourself to make a decision what, if any, type of trading is appropriate for yourself. Today, as always, I'm going to give you my opinion and my views, and this week has been a doozy. So we're going to review a lot of things that are happening, and I'm going to give you a little forecasting on what I think. And I'm going to review some of the things I've been telling you on these broadcasts that had you listened to them or investigated them, you'd be a happier man today. First of all, let's go over the current news just today, and then we'll go over what's been happening. Today, the banks came out and they did their earnings announcements for JP Morgan, Citigroup, and Wells Fargo. Basically, overall, the results have been fairly positive. And more importantly, I like to listen to the remarks of Jamie Dimon from JP Morgan, who's a rather respected guy. And basically, his point is the economy, according to all their metrics, seems to be doing just fine. So they don't see anything cracking in the economic numbers right now. He does believe interest rates will continue to rise. The 10-year note going to 4% seems to be in the bag for him, and the possibility of a 5% 10-year is not off the table. He says the reasons behind the rise is important, and that's that the economy is quite strong. Employment's quite strong. You got some inflationary pressures building up, and you've got the tax cuts, and you've got the repat money and the buybacks and all the rest of it. So everything seems to be intact. You know, as I brought to your attention on these broadcasts and everywhere else I've been speaking, the 200-day moving averages on many stocks were way away from the prices when we were up near the highs. When that occurs, the risk of going down is very, very high. I'll give you a good example. We were at about 1,500 on the 200-day moving average when Amazon hit 2050. At that point, I suggested people investigate married puts and collar strategies. Collar strategies where you sell the out-of-the-money call and take that premium and you buy a put underneath. Therefore, when the market goes in the tank, like Amazon has just done, you would have an ability to offset that risk with the put that you bought, and you would have used the call premium, say at 2,100 or 2,200 on Amazon, to pay for it. So it wouldn't have been any out-of-pocket expense. The only thing you would have given up is upside potential on Amazon above your strike price, be it 2,100 or 2,200. Obviously, where it's trading now, that doesn't seem like a real big risk at this point. What is a big risk is your equity going in the tank because you have no protection underneath. It's very important to understand these things, and I always encourage people, if they have any questions, go to optionprofessor@gmail.com. Talk to me personally. I'll give you my insight. I'll give you my opinion, and at least it'll be another ingredient in your soup, because these people you're trading through, you know, for $1 a trade, they're not going to be calling you and giving you any input. So it's up to you to be educated, up to you to be aware. And if you want to buy your insurance after Hurricane Michael hits, you're not going to be able to get any, or it's going to be prohibitively high. So when it's sunny out, like when 2050 is going on at Amazon, that's when you got to consider buying your umbrella. That's when you got to look into raincoats, not after it drops $300. Okay, so you always have to, as I always say, start talking about where the puck is going, not where the puck is. Like Wayne Gretzky used to say, the great one. You know, I always am wondering where the puck is going to be next, not where the puck is currently. I think that's a good analogy or metaphor for how to invest properly. Okay. Now, what else is happening here? It does seem like China trade tensions are easing a bit. A couple of things. One is supposedly Trump might be meeting with the gentleman from China at the G20 meeting next month. That seems conciliatory. And also, the Treasury has said that China is not a currency manipulator, despite the fact that they dropped the yuan, I think, 10% in the last month or so. So, at any rate, it seems like everyone's playing nice now, and that has been helpful to the market as well. Oil demand forecasts have been cut, but some people do believe the prices will remain rather high, probably because of all this stuff with Iran's supply and all the dodginess there. With regards to, I'll get into a few other things in a minute here. Again, they're going to be looking at earnings very closely here, and they're going to be looking at guidance. Guidance is what people think there's going to be happening. As far as Diamond is concerned, he believes next year or the year after would probably be the soonest we'd see the economy go into a fade mode. Remembering that some people believe the stock market is a 6-month in advance discounting mechanism. If you think something's going to happen in 6 or 12 months, then obviously the prices could start reflecting that before that happens. So be aware of that. Don't think that you're going to wait for the economy to start printing some lousy numbers and the stocks will still be at their high. That's probably not going to be the case. Okay, let me go over a couple of things here now. As far as the markets are concerned, let's take a look at the, as you can see from my screen here, the Dow had a big run up and now it's rolling over a little bit, and the NASDAQ as well. Let's take a look at the S&P 500. Oh, hold on here. Told everybody here, I'll tell you, I'm going to give you a little review here on what I've been talking about with regards to the VIX in a minute. Let me just see if I can get this thing squared away here for you. Okay, while we're doing that, I'll just report something to you. The VIX, it was trading between 10 and 12. And on this broadcast and others, I brought to people's attention, if it starts breaking above 13, 14, the likelihood of a drop is going to go from 50-50 up to like 80-20. And if it goes above 15 and 17, it's going to go to 90. And if it goes above 20, it's going to go to 100. So the bottom line is the probability started increasing as the VIX started increasing. And that is why I like to keep an eye on the VIX. Now the VIX has been trading above 20. In my view, until the VIX gets under 20, and better yet, under 15, I think that you have to have a little bit of caution on the bounce back rally a little bit. You know, the technical damage that was done on the downside here is rather significant. And so basically, it is a situation where you've got to be very careful on just jumping in because you've had a one-day jump here. The S&P right now has been trading. Right now it's at 2767. You can see it bounced all the way back to 2775. Once we broke under 2900, can you see that that was where it started to fall off the table? You know, when things start falling off the table from very high levels, you just don't know how far it's going to drop. So you have to be very careful of that as well. With regards to the S&P right now, you have a low point. Now, will we go down and again, another thing that I told people during where it might stop, I did tell them that you had to look for the 200-day moving average, which was at 2765. We blew through that. Right now, we're at about that. That's why it's very key where we are right now. We're hanging right around the 200-day moving average. If this thing rolls over from this area, then we're going to go back into the soup. So be careful of that. Again, with the VIX remaining above 20 and the rally coming up just to the 200-day average, I would be very cautious in this neighborhood because that VIX above 20 is a very dangerous number, and the inability to hold this area above the 200-day average would be very concerning. So be careful right around this neighborhood because the 200-day average and the VIX are still indicating that there could be trouble ahead. So be careful of that. With regards to the VIX, let's see if I can get that up here for you. And you could take a look at it because I think it's a very important thing to do. Another two things I'm going to remind people of who've been listening to the broadcast or who heard me on other broadcasts. I told you that the Dow Jones Transport Russell had led us to the upside. And once they started breaking down, I was saying that if the leaders of the transport and the Russell, which is the small cap stocks, the Russell 2000, if the leaders that led us to the upside roll over, that could be a precursor to the S&P rolling over. And that's exactly what occurred. So that's why you have to keep your antenna up and not get too positive when things are going well, nor too negative when they're going not so well. You can see we've had a spike up in the VIX, and now the VIX has come back in. But notice it's above the 20 mark, which was the former highs on the VIX. So do you understand why I'm concerned as long as it's above 20? As long as it's above 20, it's not off the table that we have another spike up in it, and another spike up in the VIX would probably correspond to another drop in the market. Again, the president has been blaming the Fed, which is ridiculous because the Fed has been going a quarter of a point for a long time now, and 3% is certainly should not choke off an economy unless the economy is built on sand. And if that's the case, our problems are bigger than a 3% 10-year note. Again, one of the problems is also that when you cut your taxes by 40% on corporations without an offsetting revenue coming in, you're going to run a very, very big deficit. And last year, the government paid out more money in interest on the debt because it was bigger than they have ever. So what does that mean? It means that if the economy were to slow and we have no revenue coming in like we used to, the deficit could get quite large. And I'm sure the bond market is concerned about that much more than it is about quarter points out of the Fed. The other thing is the tariffs. The tariffs have not come through the system yet, and that obviously can be problematic. It's supposed to be inflationary, which is not good for stocks, and it's also supposed to be a slowing in the growth of the world economy. Again, not great for stocks. Again, we've had a very large run up from the 600 area on the S&P in 09 all the way up to almost 3,000 on the S&P. That's quite a run. And a lot of it was done with cheap, free money. And we don't get cheap, free money forever. In fact, we don't get it anymore at all. So again, you need to, and of course, that's probably where the tax cut came in to try to stimulate what is being taken out by the Fed reducing its balance sheet and normalizing interest rates. But you have to be realistic when you invest. And again, to think that the stock market never will have a drop is very unrealistic. And those risks and those realisms have happened in the last week here. So again, there's your VIX. Keep an eye on it. If we get under 20, that would be good. If it gets under 15, that would be great. Other than that, you have to still be cautious because you can see from the drop in the S&P that the drop was very precipitous. Let's take a look at two other things here, and that is going to be on the Dow Jones Transportation Average. It's up 100 points. Big deal. It's down over 1,000 points. You see what I say? When it started breaking under 11.5, that was not good. And then when it broke under, obviously, 11,000, that was in the acceleration phase. So it's holding on to the 52-week low in the 9,400, but I think this 10,000 area is very important. If you break underneath that, that would be very significant. My guess is they may move it back towards 11,000, and you may create a new trading range of 10,000 and 11,000 for a while as the market tries to digest this big drop that we just had. With regards to the Russell index, that's your Russell 2000. And there you go. You can see that is going, let's take a look here. And you see, once it broke under 1,700, that was your warning signal. And if you don't heed the warning, you're in for the big avalanche. What could you have done at 1,700? You sell the 1,750 call, and you take that premium and you buy a 1,650 put. Then at least you have risk controlled at 1,650, and the last 100 points on the Russell would have been offset by the put you bought at 1,650, and it would have cost you nothing out of pocket from the standpoint of the cash flow from the 1,750 call would have paid for it. That's a strategy that comes in very handy. And for people who like to have parameters around their money, rather than just walking in every day, having no idea the upside or downside, that's a nice strategy to have on. And obviously, in hindsight, it would have been a fabulous strategy to have on in the last month. Okay, so the Russell is bouncing back a little bit, nothing to write home about, and so is most all the other markets. But as I told you, they are running into some areas, particularly on the S&P with that 200-day average, that could be problematic. So let's see how they take it home today if you're watching the markets currently on a Friday. Okay, one thing I brought to your attention is, if there's going to be inflation, as people do believe, then the gold may not stay down forever. and there has been a little bit of a turn in gold. I brought this to your attention in the last few broadcasts. Let me show you what it looks like in terms of the GDX, which is your gold miners. Okay. Now, this was something I showed, I think it was about 2 weeks ago, in the last few weeks anyway. When we were talking about if we're going to have tariffs, if we're going to have higher material costs, if there's going to be inflation in the system, the likelihood that the metals down here with a low of 17 and trading at 18, the idea that it was going to break down under 17 did not seem very good. So picking up some at 18, now we've gone to 20. That's about a 10% gain in a week. Nothing bad about that. Today it's moving back down, of course, because it had a big run. But I think if it can hold this water, to 21 is not out of the question, because that's where those former lows were. If you ever get above 23, then of course it could be off to the races. But right now, it's just making a little bit of a turn. And again, when you do it a portfolio, you generally want to do what? You want to have diversification, and you want to rotate out of things that are way up and take some of the money off the table and put it into things that are down. So if you have utilities and you have in a portfolio, if you have utilities, if you have healthcare, if you have oil, if you have the financials, if you have international, whatever you've got, if you get a big gain in it, like tech, what you do is you take a little bit off the table and then you maybe put in something into tangible assets, which would be real estate, gold, and things like that. So obviously rotating some money out of things that are way up and buying into some things that are way down balances out your portfolio. That's called basic portfolio theory, and it's where you have diversification. And when any sector gives you a tremendous gain, you take a little bit off the table. And if a sector's out of favor, that's when you put in a little bit more money. And that keeps you balanced and keeps you going forward. That's one of the ways of handling a portfolio. Okay, let me go here and discuss another one for you, which is your treasury, because everyone banging the drum on that, but frankly, that's not a drum that should be banged on at all. Because I mean, come on, 3% with a GDP running at 4.2 last quarter. I mean, that's not a high rate. That's a joke. That's called a scapegoat, and a scapegoat makes me ill when I see people use something like that as a scapegoat. You know, blame somebody else, blame the Fed. Don't blame the big budget deficits, right? Don't blame the tariffs. Don't blame anything. Let's blame the Fed. Who 90% of the nation doesn't even know who runs the Fed. At any rate, here's where you are. You're at 3.16. So it broke above, as I told you, another broadcast. If it breaks above 310, that would be an indication that the market is going to be able to go higher on yield, and it has. Now it's pulled back a little bit because we've had a tremendous in the stock market. But again, the trend is for, and again, the backlog of that, like Jamie Dimon says, is that we have a strong economy. So it's not a bad thing that rates are going up if the economy remains strong. Again, unemployment huge, very, very low. Employment's doing great. And then basically there is some pockets, autos and some real estate that is not going that great right now. But again, overall, the consumer still seems to be out there spending a lot of money. Okay, let's take a look at. So anyway, again, if you're in fixed income, you've been losing a lot of money. Why? Because as interest rates rise, your bonds are dropping. So if you're in muni funds, if you're in high yield, if you're in treasuries, your principal has been dropping. Okay. And so you're still getting your coupon, hopefully, but your principal has been dropping, and there's a reasonable expectation it may continue to drop. What do you do with your fixed income portfolio in this environment? Use your common sense. You would obviously shorten your duration. And when you shorten your duration, obviously, you're going to be able to have money coming due to reinvest at a higher yield, right? That's why you shorten your duration. Once interest rates top out, what you do is you take 2 years or whatever your short duration is, and you go out where? You go out and extend your duration because you think rates have topped out. I don't think we're there yet, but when and if you do think that is the case, then obviously that's when you extend your duration, meaning you go from 1 or 2 year instruments out to 10 or 15 or 20 year instruments. Okay. So there's not a lot of inflation priced into these markets, I don't believe, particularly in the 30 year. I mean, let's take a look at the 30 year here. You're getting 316 for a 10 year. You're almost getting 3, I think, for a 5 year. And if you loan somebody for 30 years, you're getting 333. Now, to me, obviously, a 5 year note, actually a 2 year note almost hit 3. It was at 285 the other day. So for you loan a guy money for 2 years, you get almost 3%. If you loan a guy money for 30 years, he doesn't have to pay you back for 30 years. Then you're only getting 3.3. I mean, obviously that's a very tight differential, and it makes it very much thinking to me that people are saying future inflation is just not going to happen. Are they right or wrong? We're going to find out soon, I think. Okay, let's see what else is going on out there. Oil, the stocks started to look like they were breaking out, like Chevron, and then they rolled over in a big way. Let's see what they're doing today, real quick. Okay, Chevron, you see that big dump? Okay, it could not get through the resistance of 110. So obviously Chevron does not have much upside potential beyond 110 until obviously it gets above that. Still pays you 355, but obviously it's coming down. Again, I did report to you earlier in this broadcast that they have reduced demand for gas, okay, for oil. So obviously that's not exactly music to the ears of the oil industry, right? So that's why we're on the defensive in oil. Again, we're on the defensive in just about everything except the metals, which is on the defensive a little bit today. But like I say, we are as long as we can stabilize. The reason I was used, by the way, on the S&P, people that if we can hold the lows of 2790p, where did I get that number from? 2790 for the month of August was 20. So for June and July, the low was 2691 and 2699. So if we can hold 2690 area ballpark, okay, then I will buy into the idea that it's a correction and we may get a move back up. I don't know that we're going to take out the highs, but we could get a move back up. Because again, if he meets with the Chinese guy, again, where's the puck going? Where's the puck going to be? Well, next month he's talking about meeting with the Chinese guy. If that goes well, that could be obviously a catalyst. If the Republicans win the midterms and it's happy days are here again, that would be good for the market. And so there are some things where the puck could be next month that could be a lot different right now. I'm also a believer that a lot of times they dump the markets early in the month of October, only to have them recover by the end of October. Public gets their statements. Their statements do not show the gravity of the drop that we've seen. So it would not surprise me if we hold the 2690, 2700 area, that we do rally by the end of the month. So the statements are more moderate than the aggressive lows that we've seen here this week. So again, that's just a sidebar. That's just my opinion, but I've seen it happen more than once. Okay, so anyway, that is something that helps. With regards to, and the volume was very large yesterday during the sell-off. So sometimes people might think that that is a capitulating type of a temporary low point. That's another factor to keep in play. What I don't like around the world is the DAX. The German stock market is under 12,000. Again, I've been telling you that number is important to me for a while. It's now at the 11,500 area. Even with the big jump in the S&P today, there has not been a corresponding jump in the DAX. And so basically, you have got to keep in mind that the slowdown in world economic GDP continues to be occurring a bit. And some of that is obviously spilling over to the US. And again, picking fights with everybody in the world does have a consequence. So maybe picking fights with Europe, China, and the North American continent, only time will tell, exactly how smart that has been. Because, again, calling everybody rip-off artists and things like that, generally doesn't sound like a road to a good ending. Now, of course, some people may be saying some things in public that are very inflammatory, and then behind closed doors, they may be acting quite differently. Obviously, we've got to hope that's the case if you're looking to get things resolved with Europe and China. Okay, let's see what else is going on here. Okay, let's go and do around the horn here and look at some things. some big stocks that people talk about. Amazon has earnings coming out pretty soon. Some people think it was a good buy down here in the 1700 area. It's up 68 bucks today, so it is popping up pretty well. Again, I'm going to show you what I was talking about at 2050. I'm going to show you right now where I get these numbers from as far as the 200-day moving average. Because one of the most effective things that I've seen is when the market, any market, gets 20, 30, 50% or more above its 200-day moving average, it tends to be in an area where the probabilities of a drop go way up. And probabilities is all you're really dealing with here because nobody knows exactly what the future is, right? So you try to do what? You try to have the probabilities working in your favor. And if it can work in your favor, then of course that helps you as far as trying to trying to get the probabilities on your side. Hang on one second here. All right, you can see 1633. Now that's jumping up pretty good because it was at 1500 and change, but you're at 1633. Okay, this market went up to 2050 points above the 200-day average. Can you see that? Obviously, filling in the gap between the market price and the 200-day average. That's pretty much what the market has done across the board. Okay, but I will tell you this: I've looked at a lot of stocks. And I'll give you a few right now. Raytheon, very big company, right? Let's look at the 1-year graph on some of these things. And here's what I've noticed. Raytheon, big defense company. I'm going to show you this chart, and I'm going to tell you there's many companies that fit this mold. And let me just get this thing online for you here, and that'll be that. My point is that in January, February, this thing hit 230. It went way down, and then it bounced back up. Okay, can you see it bounce back up here? But it never got back to the high. That is true of most all stocks that I looked at, big companies. Okay, so the highs were actually made on the market in January, February. And then we dropped, and then it came back up. But the rebound rally went nowhere near the high, which I'm saying there's a potential that this market may have peaked at the 2950 area on the S&P and the 27,000 or whatever it hit, 28,000 on the Dow. And looking for big gains beyond that may not be the genius thing of all times. So you may want to get at least moderately defensive on any rally. Because if we're looking at 2019 possibly being a slowdown, as Jamie Dimon said today, well, you don't want to be the last guy out of the party, right? And you don't want to be staying until the cops show up, right? So the bottom line is you may want to use advances from here on out to either lighten your load or do some asset rotation and look for other assets that may do better if the market and the economies were to slow down. But I'm showing you Raytheon here as an example. There's other companies. You go hit the 1-year graph on all these different companies. See what the highs. You're going to find that they either came up and met the high and then turned down. That's not good. Or it never could even get back to the high of January, February. It's not good. So the bottom line is that we have to be somewhat cognizant that we're 10 years into this thing, that rates are higher, not lower. The Fed is not adding money to stimulate, and that generally turns into a little less returns in the stock market. We may have one more big run if he stimulates things by talking about China and them are getting along. That could be a stimulative run, or that obviously they win, the Republicans win the elections. That could be viewed as a big stimulative thing. But that stimulative thing might be something to sell into as opposed to buy into. And that's a direct reversal of thinking than what we've been able to do for the last 10 years. Okay, so keep an eye on that. Again, it's very possible we hold this 2690 area. It's very possible that the VIX gets back under 20 and then back under 15, and that we get back on the right highway. It's very possible. Okay, but just because we get right back on the highway doesn't mean we're going to get to the same destination we came from. So be careful of that as well. All right. I'm going to go around the horn here and talk about a few other things. Let's look at the U.S. dollar. A lot of people like to look at the U.S. dollar. Again, I had been thinking that the 115 area of the euro might be an area of support and that the dollar may lose some value in the months and months ahead. Well, it might be, because here, you topped out at 97 on the dollar index, you come down to 94. You come back up to 96, you don't take out 97. If you take out 94, I'm going to be right. Okay. So basically, that's your chart formation. Now, if it takes out 96 and 97, all bets are off. But right now, that's not happening. And right now, the setup is if we take out 94, then you probably have a pretty good shot at seeing a decent drop in the dollar. Okay. So keep an eye on that. How far those highs are around 91. That might be a reasonable target if, in fact, we break 94. Okay, so keep an eye on the dollar index. The formation to me doesn't look tremendously strong because of the the lower high, 97 and 90. Again, gets above 96. You got to be flexible. Flexible. You have to be humble, and you have to gauge your risk. Okay, turning towards one other thing that had a big run up is retail stocks. And I've been telling people when they were very high that they might roll over. We got a pretty good drop in Visa, got a good drop in PayPal, got a good drop in MasterCard, right? Just like I was talking about. And here, again, because the trees don't grow to the sky. And again, if in a year from now, we're going to be in a slowdown, some people are going to start taking money off the table earlier rather than later. And that's what's happened here. So basically, you're looking at the exhale. Once you broke under 51, that thing got on the defensive. Okay. Right now, the 48 area might be some resistance, and certainly 51 area might be resistance. So there you might go into a trading range because of the holiday season and other good news. And you could basically maybe be in a trading range here of 46 to 50, something like that, 46 to 51, back and forth for a while. That's not unrealistic. Let's look at another sector real quick. The energy sector, again, should be rolling over today. Although this one here is up a little bit, but nice drop because of that forecast. You reduce forecast on the use of energy. It's not going to take the energy through the resistance of 78. It's going to roll it over. Now it hit the support of 72. Got a gap there at 75. Maybe it'll try to go up there and fill the gap. But it is on the defensive right now. But it has been in a big trading range of 78, 72. So if you're looking for a big breakout, you got to get above 78. And if you're looking for a big drop, you got to get under 72. Right now, if it's going to hold water, it looks like that gap might attract it right around 75. Let's look at the financials. Those things have been they've been banging the drum on that so long. I'm tired of the song, right? Everybody jumped into that in January. And again, look at even oil. It had the January, February high, and now you've got triple highs up there, right? 1, 2, 3. Okay, so there is resistance up there. Now let's look at your financials real quick. And then I'll wrap up. Here you go. You're at 26.52. Okay, so everyone said get into the banks because interest rates are rising. Can you see we had the high in February and January, right? Look, has it even gone anywhere near that? No. And has it rolled over to the downside? Yes. Is that bullish? Absolutely not. So you got to be careful of this stuff because a lot of things you hear on TV are not accurate. All right, this is Jim Kinney. This is I'm closing up here today. There's a lot going on. I went over quite a bit. I reviewed a lot of what I've talked about. If you've been listening to the broadcast, I think you've benefited from that. And what I do ask is you give me an email if you have any questions or I can help you in any way at all. So again, the email is option, OPTION, professor, PROFESSOR at gmail.com. Until next Friday, again, as always, I wish you all the best in your trading. And until then, good luck, and we'll see you next Friday.